Okay, so far so good, huh? Right, thanks Ellie for reminding me. Okay. All right, let me continue. Okay, so one of the things, one of the reasons, okay, besides longing and shorting in futures is we can use futures, okay, for hedging. So what is hedging? Okay, basically it is a risk management strategy that traders use to offset investment losses. Okay, the act of hedging refers to taking a position that is opposite from the current open position in a particular asset. So traders treat it as a form of insurance that protects them against negative impacts, against a negative events impact on their investments. Okay, let's take this for example. Okay, let's say Joe bought 1 Bitcoin at the spot market. Okay, and he paid 30,000 for the Bitcoin. All right. So normally that's what you do if you want to buy Bitcoin. Okay, you go to the spot market. Okay, you pay money to buy Bitcoin at whatever price, at the current market price. So let's assume the current market price is 30,000. Okay, right. So Joe has 1 Bitcoin. Right, and of course, if let's say the price of Bitcoin rises to 40,000, Joe would make a $10,000 profit. Okay, now, but what happens if the price of Bitcoin were to fall? Let's say fall to 20,000. How much would Joe lose if let's say Bitcoin would fall to 20,000?
Lose 10,000.
Yeah, lose 10,000, right? Okay. Now, in order to prevent that, okay, sometimes some traders, okay, they would open a position in the opposite direction. That means they will short Bitcoin in the futures market. Okay, so in this instance, okay, Joe would pay $30,000 to open a short position on the futures market. Right. The reason is because if let's say the price were to fall to $20,000, or $10,000, right? If the price were to fall to let's say $10,000, right? Over here, okay, Joe will be losing $20,000 in the spot market. Okay, but because he opened a position, a short position on the other direction, right? Okay, instead of losing $20,000, he makes $20,000 over here in his short position. So by hedging, by using this strategy, okay, did Joe lose a single cent?
No.
No, right? Only one person say no. What about the rest? By hedging, did Joe lose a single cent?
But Joe will have to pay for the funding rates, right?
Funding rates is very little only. That one is negligible actually.
Okay.
Well, sometimes Joe doesn't need to pay. Sometimes people pay him to short.
But Kelvin, like that, won't it mean that he will end up to break-even point? So does it mean that the hedge is like, but if you use a hedge, isn't it to make sure that you don't lose too much money?
Wait first, okay? I'll get to that. So in this example, all right, by hedging, did Joe lose any money? Come on, guys. Only like 5% answered no. The rest?
No.
No, right?
No.
Okay, then did Joe make any money?
No.
No. No, 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 no.
Maybe.
Did Joe make any money? Okay, we don't talk about the funding rate. All right, we put that aside. That one is negligible.
Oh.
No. Okay, the answer is wrong. Joe made money. Okay, see, let's see who is the smart, who's the clever one. Okay, who's the observant one. Okay, why do I say Joe makes money? Correct, Winnie, because he still owns the Bitcoin. Right? Joe still owns this Bitcoin. So even though the price has fallen to 10,000, Joe still has $10,000 because he's still holding on to the Bitcoin. Yeah, until he sells it, technically he doesn't make money lah, right? But he can sell it, right, at 10,000 and he'll still make 10,000. Yeah, Winnie is observant, all right? And doesn't mean the rest of you not smart, huh? It's just that Winnie is more observant than you guys. Okay, right. That is the reason why the big boys, okay, they hedge all the time. Okay, the financial institutions, the fund managers, okay, because they are dealing with sometimes billions of dollars of investments, okay, in their fund. Okay, right. So a tiny drop of 1%, okay, means they lose a lot of money, okay, if they don't do hedging. And most of them in their funds, they are holding on to cryptocurrencies. Okay, they are not holding on to futures. Okay, they hold Bitcoin, they hold Ethereums, they hold Solanas in their hedge funds. So that's why they hedge all the time. And just in case the market takes a sudden downturn. So in terms of dollars, okay, they break even, but as long as they're still holding on to the value, as long as they're still holding on to the asset, right? They, technically speaking, they are still making money. Okay, so this is the advantage of this strategy, hedging, right? But the downside is you need double the money to use this strategy, which means if let's say you buy 30,000 or in Bitcoin, you need to have another 30,000, for example, okay, to hedge against the position. So that's why for most people, right, who are not playing, who are not really investing in huge sums of money, right, it's not advisable to use this strategy, right? Because as I mentioned, you need double the money. In other words, you need a lot of money to do hedging.
But Kelvin, if this is for BTC ma. But let's say if we do Solana, then we buy the Solana to only $30 ma. Then we buy, then we hedge it, isn't it really very, very safe, eh?
Sorry?
If let's say we buy $500 of Solana, then we hedge $500 of Solana, no matter where it goes, we sure still very safe.
Yeah.
So actually this method we can use also.
I mean, you can use lah. But it doesn't really make a lot of difference. I mean, if it's just $500, right? You get what I'm saying? Hello?
Yeah, I understand. I just example.
Example, I mean, it's just $500. So I mean, you can use this strategy for, I mean, whatever, right? But personally, I don't, because I can use the other $500 to make even more money. You get what I'm saying? Okay. If it's 50,000 or 500,000, then that's a different thing lah. Okay. Yep. Who's that?
Sorry to cut you.
Okay. Yeah.
I'd like to understand why you say that why can we only use the same amount of capital, like 30,000 in this example? Would it be why will it not be okay if you use a smaller amount, let's say for hedging?
Okay, let's say if you use a smaller amount, right? Okay, let's say in this example, lah, okay, if you only open a short position using, okay, let's say 20,000, smaller amount to open a short position, okay, and if the market drops, you lose money because your short position is only 20,000. You get what I'm saying?
Yeah, will it always be like that, proportional?
Yeah, this is the ideal situation, lah. Ideally, is the same amount.
Kelvin,
Okay, understand.
if we use
Sorry?
if in our hedge position we use leverage,
Try not to use leverage when you hedge, lah.
reason why, if let's say, okay, let's say we got 15,000 in our account, example, 5,000 we use to buy a token, 5,000 we use to hedge, but when we use the 5,000 to hedge, but we got $10,000.
When you use leverage, you can lose more than what you put in.
But it's only for the hedge of that token, isn't it?
Oh, yeah. Say for leverage trading, all right. If you're not careful, you can lose more than what you put in
Okay, understand.
with a leverage. That's why a lot of people they lose everything because of leverage if they're not careful, lah. Not cannot, you get what I mean? Okay, but try not to, lah. Okay. Anyway, this is one strategy for you all to consider when you guys are trading huge amounts of money in the future, especially if you are building a portfolio. Okay, and your portfolio, you have coins like Bitcoin or Ethereum or Solana, and then the portfolio is in the hundreds of thousands of dollars, or maybe tens of thousands of dollars. You may consider using this strategy. All right. Okay. As of this workshop, we are talking about futures trading. Okay. So just focus on trading. All right. And just take note of this strategy. That's all. Okay. You're not going to use hedging while you're trading, right? Okay. But just take note that you can use this strategy, right, in the future when you're building a portfolio. Okay. All right. So any more questions regarding hedging? No, then I will continue. Okay. All right. So next, technical analysis and strategies. Okay. Right. So basically, technical analysis is a means of examining and predicting price movements in the financial markets. Okay, by using historical price charts and market statistics. It is based on the idea that if a trader can identify previous market patterns, they can form a fairly accurate prediction of future price trajectories. Okay. So one of the technical analysis instrument that we are going to use is this thing called candlestick charts. Right? They are the most popular way to quickly analyze price action and are part of technical analysis. Okay. So why candlestick charts? Okay, very simple. Knowing where the price of an asset has been could give us a good indication of where the price might go in the future. Okay. Certain candlestick or chart patterns allow us to predict quite accurately where the price of an asset is heading. Right. Trend lines, support and resistance levels, right, can give us a good indication of where the price of an asset might reach. All these will enable us to plan our trades more effectively. Okay. So this is how a candlestick look like, right? Okay, you have the body, which is this rectangle over here, and then you have the upper and lower wicks. Okay, wicks. Right. So a green candle represents a bullish candlestick, and a red candle, okay, represents a bearish candlestick. Right. So a candlestick is a way of displaying information about an asset's price movement for a specific period of time. Okay, for example, a 1 day. Right. So it is composed of 3 parts, as I mentioned: the upper wick, lower wick, and the body. So the wicks show the market's highest price and lowest price for the period. Okay, if let's say this is a 1 day candlestick. Okay, so the wicks will show us the market's highest price for the day and the lowest price for the day. Sorry. Okay, and then the body, okay, will represent the price range between the opening price and closing price for the period. So if it's a green candle, okay, the opening price will be below, the closing price will be at the top. For a red candle, it's the opposite. The opening price is at the top and the closing price is at the bottom. Okay. So there are some candlestick patterns that commonly appear in the charts that we look at. Okay, for example, you will have hammer, okay, the inverse hammer, or the bullish engulfing candlestick pattern. Okay, these 3 candlestick patterns, okay, commonly appear on our charts. Okay, if you can identify them, okay, your trading, okay, your trading, okay, will be at another level. Right? Because normally these candlesticks appear at the bottom of a downtrend. Okay, that means when you are able to identify these patterns, okay, these 3 patterns, okay, the hammer, inverse hammer, and bullish engulfing, okay, you may be able to spot, okay, the bottoms of a downswing, because these candlestick patterns, okay, represent a potential change in direction to the uptrend. So if you can catch a trade at the bottom or near the bottom, okay, you could potentially make a lot of profits.
But Kelvin, for the bullish engulfing pattern, right?
Yep.
Like in the markets, sometimes when we actually like see the engulfing candle, right, it's really like sibei tuaki already. Then it's like already like very high.
Normally, if okay, sibei tuaki, some people don't understand what that is. All right. All right. If let's say you see a candlestick, bullish engulfing candlestick pattern that is at least 3 times the size of the smaller red candle, okay, you don't go in. That's my rule of thumb. Yeah, sibei tuaki means make big and long candle. Okay, for those who don't understand what that means. Right. So normally,
So sibei tuaki is as if it grows longer and longer and longer, so it's like pumping. So that's not a good time for us to enter, right?
yeah. So like I said, my rule of thumb is minimum is 3:1. That means if it's more than 3 times the size of the red candle, I won't go in. Okay. Some traders is 2:1. Okay, but for me is maximum is 3:1.
But Kelvin, if let's say your that one the candle is like maybe like a bit bigger than a doji red color one, then isn't it like very fast 3:1?
Mm-hmm.
Then if let's say like it's still a very short body candle, then it doesn't really show the momentum there also. Like you see right now the bullish engulfing this example.
Just relax. Okay, relax. I know what you mean. Okay, so all right. There's no rule. Okay, there's no rule like 3 times or 2 times or 2.5 times. It's just based on individual traders. Okay, my rule is 3:1. Okay, your rule could be, I don't know, 2.5 or 2 times or 4 times. Okay, it depends on you. It depends on what is comfortable for you. You get what I'm saying? Okay, it's not a hard and fast rule, but generally, my rule is 3:1. But of course, I prefer a 2:1 or something like that. You get what I'm saying? So for me, maximum is 3. Okay, there's a saying in trading. Okay, don't chase the pump. So if you see a big and long candle, okay, that is a pump already. Okay, that means the price has already pumped. So don't chase it. Okay, just skip it. Okay, look for another coin, look for another trade. All right. Okay. So learn to recognize, okay, these 3 patterns. You don't have to memorize it, okay, because you will have these slides after the workshop. So what you do is you can actually print it out, paste it on a wall somewhere. Every time you trade, you look at the slides, okay, and then sooner or later you'll be able to recognize it. Yep, you have a video also. Is recorded. Okay, so besides these 3 candlestick patterns, okay, these are another 3 that is quite common, not as common as the first 3, okay, but still common nonetheless. Okay, that you should recognize. You try to recognize them. Okay, this one is what we call a morning star. So obviously, okay, I don't know who that guy was earlier who mentioned that doji thing, right? This is what we call a doji. With a a doji is a candlestick that has a very slim body. Okay, or Harvey, that guy is Harvey. Okay, so a doji is a candlestick pattern with a very slim body or almost no body, almost like a plus sign. Okay, so in this case, okay, obviously this body, this green candlestick is more than 3 times this doji over here. Okay, but in this case, this is called a morning star. So when you see a morning star, okay, that is also a potential sign of change in direction, okay, from a downtrend to an uptrend. Okay, so in this case, I will enter a long position, okay, to anticipate that the trend is going up. Even though this candlestick is 3 times, is more than 3 times this candlestick. Okay, but because these 3 candlestick patterns shows me that it's a morning star. All right, then there's another type of candlestick pattern called a piercing line. Okay, that means the second candlestick, okay, the second bar, this green candlestick, okay, it has already exceeded more than halfway up the red candlestick. That means the green candlestick closes, okay, more than halfway up the red candlestick.
May I know if this is practical for all time charts?
Yep, all time frame.
Okay. Thanks.
Okay, right. So the last one will be what we call 3 white soldiers. Okay, basically it's 3 green candlesticks like this. Okay, there are tens of okay, or maybe even hundreds of candlestick patterns out there. Okay, honestly, we don't have to memorize all of them. Okay, you just need to recognize these 6 for a start. Okay, and it's more than enough. Okay, right.
Kevin, sorry. Kevin, you mean after this candlestick appear, the next, after all this completed, then only we buy, right? Long or what, right?
Yeah.
So all this,
Then we long.
We long on the next segment. Okay, thanks.
We long on this.
Okay. Thanks.
Okay. Then we have the opposite. Okay, the bearish candlestick patterns. Okay. They are the exactly opposite of the bullish candlestick patterns. Okay, right. So remember the hammer and the inverse hammer, okay, for bullish candlestick patterns. Okay, now for the bearish candlestick patterns, they are called hanging man and shooting star. Okay. Okay. So you don't have to remember the names. The names are not important. Okay. Just recognize the shape. Yeah, I call this the red hammer and the inverse red hammer. Okay, and for the green one, it will be a green hammer and inverse green hammer. Okay, right. Don't really bother about the name. Right? Okay, then this is the bearish engulfing candlestick. Okay, which is the opposite of a bullish engulfing candlestick pattern. Okay. Next, you have the evening star.
Sorry, for the hangman and the shooting star, right? The shooting star should be a stronger signal than the hangman, right? Because since the price action, like the buyers try to buy upwards, but they failed, and then the sellers close it lower than the opening price. But for hangman is the sellers try to sell down, but the buyers are still pushing it higher. Then it just happen to close below the opening price. So for hangman, right, will you like wait for the following candle before you enter, or will you still take it as one of the indicator?
I would take it as one of the indicator. Right. Basically, these candlestick patterns are just giving us a warning sign that the trend is changing. Okay, it may not 100% change, but at least the signs are there that it could change. The direction could potentially change from an uptrend to a downtrend. You get what I'm saying? So where you enter, or whether you want to enter or not, okay, that would depend on other indicators, which I'm going to cover later lah. Okay, all right. Okay, then as I mentioned, the opposite of morning star is the evening star. Okay, right. Then you have this what we call a dark cloud cover. Okay, this is a little bit more complicated. Okay, right. But essentially what this is the opposite of the piercing line. But okay, and then you have the opposite of the three white soldiers. I don't know why they call it three black crows lah. Okay, right. Like I said, the names are not important. Just recognize the patterns. Just start with these 6 patterns. Okay, I advise you guys for newbies, just start with these 6 patterns. Once you're able to recognize them, then you then if you want to, okay, you can start to learn about other candlestick patterns out there. Okay, now then next will be chart patterns. Okay, instead of candlestick patterns, okay, now we have many candlesticks, okay, forming a chart pattern. So these are very commonly found in charts. Okay, you have a double top and bottom, double bottom, or what we call the MW or WM, right? Okay, so these are basically reversal chart patterns. That means if you can identify them, okay, right, you'll be able to tell whether the price, whether the price of an asset, okay, is changing, is trend or not, is changing direction or not, from uptrend to downtrend or downtrend to uptrend. Okay, then you have the head and shoulders and inverse head and shoulders. Okay, this is like our head, and then this is our left and right shoulders. Okay, head and shoulders. Okay, right. Then the rising wedges and falling wedges, which is very common in charting. Right. So these are 3 reversal chart patterns. Then you have a continuation chart patterns. Okay, continuation chart patterns means the trend continues. Okay, in the same direction. Right. As opposed to reversal chart patterns. So you have bear pennants, you have bull pennants. Okay, as I mentioned, it's very common in chartings. Right? So these are just some of the common chart patterns that I hope you guys can recognize. Right. So there are some more chart patterns over here that you can download and then use it as reference. Okay, right. Okay, so any questions before we take a 10-minute break?
Kelvin,
Okay.
could you back to the previous slide, the bearish pattern?
Yeah.
Just to take a screenshot. Thank you.
This one? Or this one?
No, the bearish, the bearish one, the one that you first went. Yeah, just I think 3 forward.
Way forward. Okay. This one?
Yeah, highest bearish. Okay, yeah. Just 2 seconds on that. Thanks.
Yeah. What about this? Don't worry, you can print this slide out. Okay, so no questions, no questions. Then we just take a short 10 minutes break.
Wait, got.
Avi, right?
Kelvin, but for this kind of like bullish and bearish patterns, like later in the course, later in the training, will you teach us like, like for those kind of rising wedge or even like any kind of triangle patterns or pennant patterns, right?
Yeah.
Like when there's a consolidation, like you see these bearish patterns, right? They will say like, oh, okay, like if it consolidates like that from a long short, then means it's actually a bearish pattern. But in the Bitcoin, like in our crypto journey, right? Like sometimes it seems like it doesn't really follow this thing very exactly. Like
Yeah,
suddenly it consolidate, then put the seed,
there
the
is
report
no-
come out, then hood go up.
There's no 100% in charting. Okay, that's one thing you need to know, right? But
Generally, consistent.
generally, the patterns are quite accurate. Okay, generally,
Okay.
at least maybe about 70 to 80%. Okay, nothing is 100%, guys. You got to remember all these patterns. They are not 100%. If they're 100%, okay, nobody will lose money in trading already. Okay, right. So they are not 100%, but they are almost 70% accurate.
Okay, understand.
But as I mentioned, you do not need to spend time to go and study it, go and memorize it. Don't have to. Okay, just know that these patterns exist, right? And slowly they try to recognize them. Robots will take over the world. Yeah.
Hey, Kelvin, can I ask something for engulfing, right? Does it need to engulf the wick as well, or just the body?
Only just the body.
Thank you.
Hey, Kelvin, also another thing, like how come sometimes you will form a body and sometimes you will form a wig? What does it mean? Like like sometimes there's a very long wig, but sometimes it's a very long body. How come like sometimes it's a body, sometimes it's a wig? What does it mean? Does it mean that price action is not like there long enough? Like you just like 动到一下, that's why it's a wig.
Okay. So basically what this, okay, every candlestick basically tells a story lah. Okay, let's say if this is a 1-day candlestick, okay, right? So let's say for example, okay, at opening, okay, Bitcoin's price is $10,000. Okay, so at this point, okay, at this point it will be $10,000. So during the day, okay, let's say Bitcoin went as high as $30,000. Okay, and went as low as $5,000. Okay, then finally at the end of the day, it closed at $15,000. Okay, so what this candlestick will show is, okay, the opening price is $10,000. At the top of the wick here, it will be $30,000 because during the day, Bitcoin went as high as $30,000. And then at the bottom of the wick here, it will show $5,000 because during the day, Bitcoin went as low as $5,000. And then finally, over here, it will show $15,000 because at the end of the day, Bitcoin closed at $15,000. You get what I'm saying, Harvey? So let's say if you see a very long one, Yeah.
Oh.
Example lah, hypothetical lah. During the day, okay,
Hmm.
Bitcoin opened at 20,000 and then went as high as 100,000.
Oh.
And then
Okay.
dropped to 5,000. So you see a very long wick here lah. Then at the top of the end of the week, that's 100,000.
Oh, okay.
You know what I'm saying?
Okay, understand.
So that's how you analyze a candlestick.
So the closing is more important or the lowest point is more important?
Closing.
So actually the lowest point, we don't take too much, like we see, like, there are some breakout patterns, right? Like the week is like breaking out, right? That one we don't care lah, because it didn't break out, right?
Actually everything is important. Later you understand why.
Okay.
Okay.
Then later I ask again.
Okay. Okay, guys. Let's take a 10 minutes break. Okay, before Harvey asks any more questions. Okay, let's take a 10-minute break. We take a toilet break. We come back at what's the time now? Now is 10:58. Okay, we come back at 11:10. Okay. So see you guys later, 11:10.